This is the kind of backtest people post to prove they've figured it out. Smooth, profitable, up and to the right. But that's not what actually happened over the past year. Month by month, this thing blew the account, reset, and blew it again. And there were entire months with no payouts. So this week, I took the strongest of the 3 strategies I developed last week and adapted it to actually fit real prop firm parameters. A filter to cut out bad trades, a volatility-based stop, a trailing target, a strict trading window, a forced flatten. Then I ran the real math, not win rate, actual dollars. After profit sharing, after taxes, like I'd been trading on a real funded account for the past year. And the number I got back genuinely surprised me. It made me a lot more optimistic about whether this path overall could work. Let's go through it. This week I was looking to create a regime-based strategy that was profitable in a prop firm before optimizing any of the parameters. We started this project last week, but that was more getting the structure in place, and then this week was able to dive deeper into strategy development. The 3 strategies we developed last week were a momentum one for a bullish market, a mean reversion one for a bearish market, and a squeeze for a sideways market. However, the only one that we go in depth to developing today is the momentum for the bullish market. Here you can see the indicator that was used to determine the regime of the market. Basic momentum strategy: if it's above the 20-day moving average, take a long. If it's below, take a short with a 2-to-1 risk to reward ratio. Now, this current week, I wanted to build in filters to the strategies so that they would fit within prop firm parameters and see if they were truly profitable. So I started with the base code of the old momentum strategy that was basic on purpose so that I could build upon it. Then, as you can see, this is the same strategy, just with some new pieces added in. So what are those new pieces? Well, put the different inputs at the top just so that they're easy to read and they could be changed. I don't really want to do that though because I don't want to overfit. Added a ADX filter, an ATR based stop, and a trailing take profit. These things were huge. I really wanted to focus on position sizing that week. Then more so the prop firm parameters of time window and flatten. So when can we trade, and then an ability to flatten our trades if one is held outside of that window. Yeah, so again, this was just pulling the inputs to the top of the screen. All it really did is just make them easier to see, and I could just go in there and tweak them if I wanted to. Next is the ADX filter, which I learned stands for average directional filter. So the reason I added this was to cut down on low probability trades. Like if we look here, this strategy took over 700 trades in the matter of a week, over 100 a day. That's way too high frequency for my liking and unnecessary. The more trades you have, the more effect commissions and slippage you're going to have, and the more of a disadvantage you're going to have to people with better resources. So what does this actually do? It's essentially a confirmation for the momentum breakout. It's essentially asking, is this just a wiggle up in price, or is price actually going to go based off of that? So say this line is the simple moving average. What the strategy used to do is whenever price would cross this line, it would make a trade. So if it crossed below, it would enter a short right here. And then if it immediately crossed back up, it would enter a long right here. And it could just keep doing that back and forth before it ever broke out and take a bunch of unnecessary poor trades. So what the ADX filter does is it essentially creates a buffer around the simple moving average. And so if price stays in this range, a trade won't be taken. It won't be taken until it breaks out of that range, a more confirmed breakout, taking less but higher quality trades. ATR based stop. Why was this implemented? This is to help with position sizing and risk management. The idea is volatility in the market varies, and it can vary pretty drastically. It might not make the most sense to always have the same stop loss. In a low volatility market, you might never hit your stop loss, but in a high volatility market, you might constantly get stopped out. What this does is it allows the stop loss to be flexible. So how does it do that? How does it determine the stop loss? Well, let's say we have a candlestick here and a candlestick here, and then price is right there. So it's going to take the close value, which is right here, and then subtract the stop multiple times ATR. So you have your standard stop, which is the stop multiple of, let's say, 5, and then you have your coefficient, which is the volatility in this case. And so if it's higher volatility, you're going to get a higher value for this stop loss, meaning that the stop loss is going to be set lower than it normally would. If you had a smaller value for the volatility, you would be subtracting a smaller amount from the closing value of the previous bar, and you would be left with a smaller stop loss. So trailing take profit, or more accurately, a trailing stop loss, it kind of functions as an intermediary. The idea is you want to let your winners run and cut your losses early. So if you're trading a breakout and you enter here and then you have a take profit at a fixed 10 points here, it goes up, it hits your take profit. Okay, cool. But the whole point of a breakout in a momentum strategy is that it follows its momentum. And a lot of the times it keeps climbing. So that's where the idea of let your winners run comes in. So how do you automate this? With a trailing stop loss, or I like to think of it as a trailing take profit. Say your take profit was here at the 10 points. Say you enter at the same point and you have your stop loss here at minus 5 points, and then price goes up, it hits a certain threshold, and then it hits a certain threshold, and so that's trail points. Then the strategy begins to trail. So the stop loss moves up, and then price moves up more, so then the stop loss moves up more, and then price moves up more, and then the stop loss moves up more. But it never moves down, so then if price does come down, okay, well then you're exited here. And that's the reason why I like to think of it as a trailing take profit, because you entered here, you exited here, this is all your profit. It is a stop loss, but it functions sort of as a take profit. And then how far this stop loss trails is going to be just like the ATR based stop, where it's based on the volatility. So here, same thing. It's based on the volatility. How wildly is price moving? If it's moving very wildly, we're going to back up that stop a little bit, even if it's trailing. This is the boring stuff. All it does is it integrates Top Step's rule of no overnight holds into the algorithm. Overnight drift is one of the most studied and cited phenomenons in quant finance, and it is where the majority of returns come from, is overnight holds. So this does suck a little bit, but it also makes sense, as it does help manage for risk a lot on their end. Then, last filter we added, flatten. This is off the time window thing. If the hold is about to go out of the time window, very complicated, it closes all the positions. So, what were the results of these improvements? Well, actually really good. Now you might be saying, well, that doesn't look very good. It pretty drastically underperformed buying and holding. But we're not optimizing for returns. We're optimizing for prop firm success. Very different. This one has way too much volatility to ever survive the parameters of a prop firm challenge. And 2, it has overnight holds, which is where most of the returns are coming from on this buy and hold. Our strategy is a much more smooth curve. And even still, like 5% a year, it isn't terrible. What I like about this much more is the number of trades it takes. So it took about 1,500 trades. So about 2 to 3 a day. The time frame of this backtest is a year, by the way. And a year on 15-minute intervals, trading 2 to 3 times a day with well over 1,000 trades. So it's a pretty sizable sample. I was very surprised to see this, very pleasantly surprised, because I didn't optimize the strategy at all. I just put those changes in and then ran it, and this was the result. So by nature of a breakout strategy, especially with the trailing stop loss, take profit, whatever you want to call it, more of our trades are losing than winning. We just have a really good risk to reward ratio, and that's actually pretty normal for prop firms, because you have to have small losses because of all the limitations on daily drawdowns and intraday limits. You just can't have big losses, and if you're gonna have small losses, you're gonna have a lot of them. Average bars in trade, 8. This is on a 15-minute interval, so that's 2 hours. That's honestly perfect to me for a prop firm. I want them to be long enough where there's not too many to where I'm not losing that much to commissions and slippage. They're big enough trades. But I want them to be small enough to where one trade isn't going to bring me all the way down to my drawdown limit. So now a little bit more analytical. How profitable do I actually need to be? Was that enough? So here's how I checked it. I went through day by day, week by week, looking at the cumulative P&L of the strategy, then looking over to the rules of the prop firm, and then putting all that information into a spreadsheet I made to calculate profitability compared to expenses. So there are some very key assumptions that are also very beneficial to me, so this math is in no way perfect and a little bit hopeful and optimistic. 1, I don't get moved alive. In this situation, you don't want to get moved alive. These strategies aren't built for life, as we can see. If you were to just trade that strategy live outside of a prop firm, it would drastically underperform a buy and hold. So it's actually ideal to not get moved to live with prop firms. That's why a lot of people create different accounts. I assumed that over the course of this year, I would not get moved to live. I've never traded with prop firms. I don't know how accurate that is. But I was kind of assuming if I did get moved to live, I'd just make a different account. Then this one's a little weird. So if I were to hypothetically pass the combine, the evaluation, and then get moved to the funded part where you can get payouts, your drawdown is no longer trailing. So you want to give yourself as much of a cushion as you can. So what I would do is wait for the equity to build up $6,000 above the starting point, and the drawdown was $2,000 below. And then once it hit $6,000 above the starting point, I could take that $6,000 profit. You can take a payout of $6,000 on this account, but I wouldn't. I would only take a third. I'd only take $2,000, because then I would still have $6,000 in equity in cushion, so that if I did hit $5,000 in drawdown, I wouldn't blow the account. Now, this can definitely be optimized, because obviously there were then some times where equity up to $54,000 and then hit the drawdown limit, could have cashed out at $4,000, didn't, now nothing. So I'd love to see a video on someone explaining the math behind this and what's the optimal way to take payouts. If anyone knows, please let me know. So something to note, you pay a monthly fee and you automatically get the account reset every month from that fee. You can also pay that same fee at any point in the month to reset your account if you blow it. So what I did, if the account was blown in the first 2 weeks of the month, pay the fee again to reset. Otherwise, wait the month to be charged again and let it reset that way. Again, there's definitely more ways to optimize this. I think if you're confident in your strategy and you've backtested it enough, probably just reset every time. You should be confident enough that you're gonna pass it and that over the long term, the probabilities are in your favor. So here are the results. It's kind of a lot to look at, so we're gonna go piece by piece. It's broken up into different months because that's when the fees are charged. We'll start with the incomes because that's simpler. The only income is payouts, but then there's deduction. So there's the 90% rule where Top Step takes 10% of your profits, and then after that, you have to set aside money for taxes. And since this is taxed differently than a salary, you have to set aside a somewhat decent amount for the money you're making. So as an estimate, I just used a coefficient of 0.7 for tax, so setting aside 30% of the payout after Top Step takes their 10%. And as you can see, that's pretty substantial. If you get a $2,000 payout, what's actually hitting your bank account that you can use is more like $2,500. So that's the incomes. Now the expenses. So the first and largest expense is the prop firm subscription to Top Step. The good thing about this only gets charged during the combine, not once you're funded, because once you're funded, they get their slice of the pot through the 10% that they take off your profits. So that's why some months have the $85 charge, other months do not have it. Next is the TradingView subscription. This one is not a hypothetical. This one I actually did pay for. That's how I was able to do that large back test. 100% worth it. I got a 70% off sale since it was the 4th of July. $17. Take that every day of the week. The next expense is Prop Sync X. So what this does is it takes the alerts from TradingView that were generated from the PineScript algorithm, and it sends those to, I think Tradeovate is the platform that Top Step uses, the broker, to then execute the trades, and then you see those results in Top Step. So the 5-step process: PineScript algorithm, TradingView, JSON alert, PropSync as the bridge to the broker, Tradeovate as the broker, Top Step seeing the results and actually paying you. Fourth is the virtual server. Now this is actually super cheap, but it's just a virtual machine so that you can have this algo going in the background at all times without having to worry about your Wi-Fi going down or your computer turning off or anything like that. It just does it for you on a virtual server somewhere else. And then this isn't a different expense, but I just added it down here at the bottom on top of the monthly 85. If there was an additional reset in the first 2 weeks, put that down in the 5th row. Next, we have the rules of the Top Step account. Feel free to pause and take a look at that if you want. Then we have the cumulative income and expenses, and then the per month income and expenses. So the cumulative looks great. Oh, bang, up and to the right, profitable, let's go, making a ton of money. However, I don't think that tells the full story, and I'm kind of glad I have to go through this data by hand, because the per month tells a much different story, which I imagine could be pretty emotionally taxing, even if you're having an algorithm doing it. Before you get your first payout, you're already down like 300, so you're in the negative. And then, okay, month 3 goes well. But then for weeks on weeks, months on months, you're just getting worse. Month 5, there's no payout at all. Month 6, a little better. Okay, now progress is coming back. And then month 9, on top of the world. I think that this was January. And that obviously pays for all the past expenses and gives you a lot of confidence you can keep doing it. But that's 9 months in. And then the next 3 months, not a single payout. Reset on the month, blow the account in like 3 days. Reset again, pay the additional fee, blow the account again. Done for the month. Just sitting around waiting. Then next month comes, reset, blow the account again. Pay the additional fee, reset, blow the account again. Wait for the next month. Next month comes, reset, blow it, reset, blow it. That's gotta be demoralizing. And that's months on end. And like, yeah, okay, you look at it over the course of a year and it's fine. And when you look at this, it's just up and to the right. But the emotional experience is something I don't know is talked about enough. It's talked about a lot on an intraday basis for discretionary traders of the highs and lows of the actual trade, which is something you don't really think about as an algorithmic trader. But the emotional turmoil over a year is something I don't really hear talked about. This is just another good representation. Boom, on the left looks like, Bala businessman. On the right just looks like a gambler. Regardless, this was very inspiring to see. I'm excited to keep refining some of the parameters to make it more accurate. I didn't have commissions and slippage in place. I do want to add those in place when I do this next time. And I'm excited to do it for the different strategies and do it on different years and really just get this bulletproof with absolute confidence before I put it into place. Then lastly, kind of random, me and my friend are working on a hidden Markov model regime detector, but very applicable to trading, especially because I'm trying to do regime-based strategies. So the goal is to determine how probable it is to go from one state to another. That's what a hidden Markov chain is. It's the chain between those events. So the different states in trading, for example, could be different regimes. What's the probability to go from bull to bear, from bear to bull, from bull to bull? And then you combine all that and hopefully get a pretty accurate model. This is just a nice visual example that he drew up. For example, if you're at full bearish, well, the probability that you go to bearish, pretty high. You normally don't stay at extremes for too long. And then if you're at full bullish, the probability that you're going to go to bullish is very high. Price normally doesn't stay at extremes for too long. The probability that you're going to go to full bearish, obviously very low. It seems like common sense. It sort of is, but once you start getting into the matrices, it gets a little bit more difficult because all of these are interconnected too. What's the probability to go from full bearish back to full bullish, from full bearish to bearish, from stagnant bearish to bullish, from bullish to bearish? It becomes a much more complex interwoven system. So how am I going to start? What am I going to do next? First, I have to figure out how to define each type of regime. What constitutes a bull market? Next, create the structure for the matrix of the different probabilities to go between states. Then gather data and find those probabilities. Now, the just look method doesn't seem very accurate, but I'm not sure on how to calculate it, so that's going to be the tricky part to figure out, I think. Alright, takeaway from this week. This is fun. I'm enjoying myself, learning a lot. A lot of things are new and challenging, so it makes it very exciting to overcome those challenges. I'm having a good time with it, and at some point money will be the goal. Right now, just learning and having fun is the goal, so happy to say it's working. Takeaway from my reading. This is reading and just at large what people are talking about. There's a lot of fear mongering. There's a lot of fear mongering. Yes, I get it. There probably is a bubble on the horizon, but maybe instead of just spewing fear, maybe advice could be a better approach. I guess fear is what sells. Fear is what motivates people to act, to buy courses, to buy information, to move their money to someone who they think is an expert. So I guess tactically it makes sense. It's just a little annoying to see. Next week's goals. I'm pretty excited about these. First, refine each strategy with a why. This week, I was gonna do that, but it was a lot more work than I thought, so I only did the momentum strategy. Next week, I'll hopefully do the rest. Then, since I'll have all three strategies for all three regimes, add a regime switch for when the regime switches, switch the strategy. Lastly, test over multiple years. I was testing on 15-minute intervals, so a year was a long time. There was 1,500 trades. That's much better than last week where I only tested on a week of data. But if I have the ability to test on more data, I'm going to take the opportunity to test on as much data as I can. I really want to make sure it's robust. All right, as always, thank you for listening. Just got to say, this is purely a journal. I'm not an expert, and this is in no way advice. I'm just documenting my learning.